Welcome to the October 2nd, 2023 Advance Report from McGowanGroup Wealth Management clients. Thank you for tuning in today for another update on the global financial markets. I'm Spencer McGowan, your financial weatherman, president, McGowanGroup Wealth Management, a team of 10, the team that cares, serving affluent families right here from the Crescent in Dallas. We've been busy all week to bring you the most important events in the global financial markets. And the first one on everybody's mind, shutdown. Run in circles, scream and shout. We're not going to have any government. It's going to be chaos and, well, you know, there'll be pandemonium, dogs kissing cats and stuff like that. So most people, when they hear government shutdown, they think a lot of awful things. The fact is, it's happened many times throughout history. When they don't get a budget agreed on, then the government shuts down over a particular issue. I'm going to show you a very relevant example that actually takes the market and shows what happened in the last major shutdown. The longest shutdown ever was 35 days without overregulation, without bureaucrats. I mean, the military obviously is important, but however, the military was not disrupted to the extent you might imagine because people get furloughed or they actually get their back pay. So the disruption was a lot less than expected, and it's happened before. So here we do see a downdraft in the Dow. Most of this, September is the worst trading month. The last 10 days of September are statistically the worst 10 days for equity performance, and you can kind of see it here in the late September downdraft. Plus the Federal Reserve signaled higher for longer. Now this has been a big tightening cycle. This parallels the last big government shutdown. So here's the Dow. This was the September downdraft, the March downdraft, and the Dow's left with about a 2% gain for the year after this week. Now we go to the shutdown in 2018. Here's the parallel. There had been a big Fed tightening cycle and talk of a looming recession. Sound familiar? Wow, that was 2018. The low was the Dow at 22,000. The government shut down right here. Okay, so you could say part of that decline might have been the dreaded government shutdown, but there were other factors in play, and the government shut down for 35 days over the border wall funding. And here, look at that. This is what happened during the shutdown when we didn't have the gift of big government for that long. Wow. It looks like it was actually good for the market. Maybe there was a downdraft first and we had it in September, which is very typical of September. But this is December of 21, or this is December of 2018. And this, if we go 4 months after the shutdown, during the shutdown, the Dow goes from 22,000 to 24,000. Wow, it didn't seem to be a danger to the market. The market didn't really care that the government was shut down based on this chart. Then you go all the way up to 26,000 by February. So you look out 3 months later, things were pretty good and the market was recovering. Part of the reason is the Fed paused their rate cuts, but they said, we're going to do 1 or 2 more. That sounds like exactly what Jerome Powell said, you know, this month, and the downdraft looks a lot like this. Well, it's a very parallel scenario, and this would say, I'm not really going to worry about it. What are we going to worry about? Higher gasoline prices. Wow. And inflation might come back. Oil went to $95 late Wednesday night, about 9:30 our time. It goes to $95. I found out the next morning because I was doing something else. But you see here, oil comes back to about 91. That is the highest level, right, since 2022. Why is that significant? The companies were making good money here at 75. And if we look at the long-term success of an inflation hedge, well, like Chevron, for example, let's take a look at that. This is 1980. Wow. Long time. $6 to $169. That's a pretty good long-term chart, plus a dividend on top of it. And right now, companies are not spending on capital to overproduce and oversupply the market like they did in 2014. There's the pandemic. So this was a long, ugly cycle, about 6 or 7 years. If I take 6 or 7 years, apply it here, I could have a great cycle, until 2026, 27, maybe longer, because companies are not over-investing and potentially oversupplying the market. So it may look more like one of these periods where you have a multiple gain and at the same time you get good dividends. Energy infrastructure is part of our portfolios. Remember, if we talk about something, it's not a recommendation for your plan till you come down or do a Zoom or a phone call with us and actually construct a plan where we'll get more specific. This is the National Home Price Index, Case-Shiller. Notice home prices actually reached an all-time high. What a big surprise. This is a huge surprise in 23 because the market was really ugly in the second half of 22, and now we're back over that. Part of it is if you got a 3% mortgage, you don't want to sell, right? Because then you'd have an 8% mortgage if you move. So there's not a lot of supply on the market. New homes are the most popular for obvious reasons with people right now. But the market is still very little activity compared to the bidding wars last year. How is North Texas? North Texas is a hotbed of activity, lots of people moving in, great economy. This was a bidding war, and you could see it was actually, the price increases were more in Dallas than the nationwide average. This is the bidding war frenzy that peaked in June of 22. Then you had about a 10% downdraft. North Texas, Dallas, still about 3 to 4% below the peak of the bidding frenzy last year. So that's your real estate update. We're working for the future episodes to bring you an update on the actual values of commercial properties. That takes a lot more detail to get there, but I'll bring it to you as soon as I got it. Be sure to subscribe and then you'll get a notification. Here we go. This is the 20-year Treasury. This is a disaster. So if you bought the Vanguard Long-Term Government Securities Fund, when interest rates were near zero, the price, this is the low-cost ETF for the 20-year Treasury, by the way, the price equivalent was 165, now it's 90 due to the Fed tightening cycle, rates coming up. The 10-year U.S. Treasury hit 4 2/3% this week, settled back to about 4.5%. There are a lot of good discount bonds, but we prefer the global high yield markets because you get a higher yield and you get a much deeper discount. But this really says that the Treasury's biggest danger is that interest increases in the long Treasury yields, price decreases, could begin to spiral if they go too far. So they may actually fulfill their projections and start to come back down before they endanger the banks. This is to not to. This is Rumble. We'll call it a social media stock. And we saw that they didn't have much revenue compared to the value of the company, and it's a money-losing enterprise and a tech-related company. So you can see that this is not a good chart at all from 18 to 5. Don't buy companies that are losing money. Now, Snap has actually made money at times. This is Snapchat. Just because it's tech and social media doesn't mean that, if you're in the wrong space, that you can't get hurt. You can get hurt bad here. This one's gone from 83 to 8, and it IPO'd back here in 2017 at near $30. So I just want to give you a couple of examples. Snapchat has had many periods where it was losing money, and these are two lessons that say, if you like something, but it's not making money yet, it may be better to wait. I'm Spencer McGowan, President, McGowanGroup Wealth Management. Thank you for joining us. We'll be back next week with the best in financial news. Thank you for tuning in to Net Worth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowanGroup, Apple Podcasts, Net Worth Radio, and networthradio.com. The Net Worth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowanGroup Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowanGroup Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.